Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about 2 or 3 key aspects around mutual funds. As we learn that there is the new fund offers, which were on a bit of a hiatus recently, might be coming out soon. So therefore, there could be a bevy of NFOs that we could see launched. And so don't get confused. We'll try and ask our experts what are their views on some of the upcoming NFOs, if they have a sense of which are the ones that is coming out. Post that, we would love to talk to them about whether large cap funds should be a part of the portfolio, or is it better to do away with them and look at ETFs, simply because not just the last 1 year, but possibly the last 2 or 3 years, large cap mutual funds by and large have not necessarily given a significant alpha or index ETFs. At least that's my understanding. I would love to know the guests' views there. And last but not the least, we will talk about whether thematic funds should be a part of portfolios or no, considering that more often than not, we hear people say that don't look at thematic funds. But if the portfolio is large enough and if the investor is willing to take a little bit of risk, are thematic funds good to add a little bit of alpha? And if so, which are those? So to talk about these 3 topics, we have Tarun Birani, founder and director, TBNG Capital Advisors, and Santosh Joseph, founder and managing partner at Germinate Investor Services. Gentlemen, both of you, thanks for joining in.
Hi, good afternoon.
Very good afternoon. Actually, I'll take the NFO topic last. Let's start off with large cap funds. Tarun, can I start with you? One thing is to rely on narrative. The other is to look at numbers. And hard numbers do suggest that, save for a few, by and large cap funds really haven't beaten an index ETF in a meaningful way. So why pay that high cost? What's your thought here?
Right. Thank you, Neeraj. You are bang on, and I have some data to share on based on the SPIVA study, and I think SPIVA is authority around the research around the ETF versus active versus passive, and based on their research, last 10 years, 70%, approximately 70% of the active funds have underperformed the benchmarks, their respective benchmarks. So again, I looked at some hard number from a trailing return data also. From a 3 years perspective, I can see out of almost 30-35 funds, only 6 funds have outperformed, let's say, a Nifty 50 in the large cap category. And in a 5-year category, 5-year trailing returns, I could see only 1 or 2 winners outperforming the Nifty. So which clearly is telling us that there is a challenge happening, and most of the large cap funds are not able to outperform. When you look at the, let's say, global data and you deep dive, what is the problem there? So based on the SEBI categorization of large cap funds, 80% of your investment should be on top 100 stocks, right? So the space is more or less same for everyone, similar, right? So there the information asymmetry is, this efficiency is very high. And due to this, most of these stocks are high research stocks. So not much can be done. I think where one can do much larger is in terms of, let's say, sector plays and all those. But Nifty again is doing very well in terms of capturing all those trends very quickly. So we are seeing that most of these top indexes are actually doing better than these large cap. And my suggestion also would be to continue with, at least in the large cap category, with the index funds, and they do much better than them.
Okay, thanks. Santosh, is your view different? And if so, why?
I think the numbers are there for us to look at, and the analysis is clear that there has been over the last 3 to 5 years a clear direction that it's pointing to, that how ETFs or index funds have kept in line with the performance of the market in general, and therefore the reduction of the dependence of large cap funds to deliver that kind of return. Now, let's not even get to the cost, because we all know how different the costs are. But when it comes to performance, we're talking about 2 things here. One, meeting the expectation of a large cap space with the diversified fund or a large cap index fund, or which is also an ETF. The second, is it possible to actually outperform or create an alpha? Now, let's break this down and say, to create an alpha, I think is expecting too much out of a large cap fund, because of the contours of the way we are now, after the rationalization of the scheme has happened, the universe remaining the same. Now, let's also, like he said, Nifty and the top 100 stock, which is a static list of universe, also are the most liquid part of the stocks. FNO stocks, and they have the ability to go through a large amount of transactions with very less impact on the price of the stock. Now add a layer to that saying that this is where everybody is buying and there's huge amount of liquidity, and even the large cap funds also buying the same thing, and index funds also buying into the same thing. Now we are saying alpha generation is not a realistic expectation over there, number one. Number two, if you want to trail or sort of shadow the large cap index, there are better alternatives than just a large cap fund. So on these two counts, we made a reasonable assessment saying that there is a case today to believe that if the client is not very particular of investing in the physical mode, or is okay to take the delivery of the ETF in his demat account, then he'll be able to get the benefit of the large cap fund through an ETF or an index fund with practically no extra fuss or cost.
Okay, so since there's a consensus there, let me not probe this even further. Viewers, you get the answer from a large cap. If you have an SIP in a large cap fund, maybe talk to your advisor and try and figure out if there is a way to at least reduce the cost, if not generate alpha, because both our experts are saying that alpha generation through large caps is is an oxymoron, so to say. So let's just leave that out.
Yeah, okay. You should be happy to get the index return and give you the comfortable feel.
Yeah. I mean, yeah. So for that reasons, but again, if that outperformance is not happening, at least try and figure out if you can reduce the cost that way. So thank you for both of you for that. The second topic, and Santosh, I want to start with you on this one. Thematic funds, they are usually a no-no. And yes, if somebody is not full-time into this, maybe thematic funds would be a very risky adventure. But let's try and look at it from a perspective of people who have a fairly large diversified portfolio and are willing to take a little bit of risks. Do you, to such clients of yours, recommend thematic funds, or even for those, it's a strict avoid, and why?
See, in general, like you said, I'd go with you saying it is a strict no-no, because I think many investors, when you look at thematic funds, you're trying to ride a wave. You're trying to be better than the market. You're trying to, go down the path away from diversification into sectoral or a sort of a concentrated approach. Now, within that, the reason why we say no in general when we're talking on forums like these is that I do not know what the investor's thinking, number one, and I do not know what the outcome is, the expectation that they have. For example, if I take the banking and the financial services, they are a large part of the index in itself. Now, if I take that as a thematic versus something else as a thematic story, there could be chalk and cheese in terms of difference, in terms of their exposure in the market in itself. That's why it's a generically a no answer. But for a savvy, seasoned investor who knows slightly better, now we can't even say the same thing in similar thought for an IT sector, which is again a big part of our economy, a big part of diversified portfolios. But if someone knows to play it, someone can understand the nuances, or someone can understand the whole opportunity that it presents. For example, you look at this particular calendar year, metals have done very well, even though there's a sharp correction that's ensured after that. But still, if someone is able to play that entire rally well, and if you are someone who understood the metals as a space, or maybe you're into that business, or that there is an opportunity. But for general investors, stick to diversified funds, where all these would be well represented by your fund manager or the scheme that you are in the right proportion or measure. So therefore, thematic tend to get a little aggressive for the person who does not know why he's getting into it. And for a seasoned guy, it's a nice opportunity for him to, rather than go for the whole buffet, choose the one meal that he wants to go after.
Interesting thoughts. Tarun, the reason why this becomes important is because, a bunch of people, rightly or wrongly, will get influenced when a large fund house with a decorated fund manager would introduce an NFO of a thematic fund. And in the past, some of these fund managers have gone right. So therefore, it's easy for a person to think that let me make a small investment here. So therefore, I'm asking from a perspective of such a person that is it okay, or is it a strict no-no if somebody is very passive in nature?
So I think most of the points Santosh has already covered. I also strongly believe that there is no need to do so much of experimentation where the normal diversified funds are able to capture a lot of stuff for you. But again, let me try to bring in another perspective. This is more to do with from a financial planning angle. So I feel there are three needs most of us have, right? One is a safety need, another is stability need, and third is an aspiration need. a safety and a stability need is mostly taken care of with most of your market driven products, right, which are more diversified. And your normal Markowitz theory talks about high risk high reward, right? I think that is where I think most of the your safety and stability block, or your goals like your retirement goal or your children future goal, all these things you can take care of that. But I think the third part is the aspiration part. And aspiration is where you look at high risk bet, concentrated bet, where you look at, let's say, investment into a specific sectors which you understand. So since you mentioned that somebody who has a large enough portfolio, I would say where safety and stability is already taken care of, and one is extremely bullish on a sector. Let's say I am working in a healthcare sector. I understand where in 10 years this healthcare sector is going to move in, where the technology sector is going to move in. I work with some folks who got ESOPs in technology sector, and they have been holding ESOPs of large quantity. Again, very concentrated. That's a problem area. But that is again where one can look at if you're superbly bullish and your safety and stability is taken care of. I think then you can look at some part of allocation in that aspiration thing. But what normally people do, and let's say if I look at last 1 year, where your most of the high growth tech stocks were like every evening going up by 10%, 5%, right? And people get crazy and they forget the safety and stability, put all the money there. And then today I see all these guys are sitting with 70, 80% mark to market loss on their portfolios. So maybe one can take that as a different perspective from a financial planning angle. But what Santosh said, I completely agree to that. Yeah.
Okay, there's a consensus out here too. Let's see if we can get anti-consensus on the third part. And that's always welcome, but nevertheless, it's not a necessity. So Tarun, I'll start this one with you again. And that is on possibly new NFOs restarting from the month of July. Grapevine has it that it'll happen very, very shortly. So some of the fund houses would have held back their NFOs or have had to hold back their NFOs in the last couple of months. They'll probably be coming out as well. So we could actually be, in a manner of speaking, flooded with new fund offers. Have you had a chance to look at what could some of these upcoming NFOs be? And is there a particular one that you are watching out for because of the fund manager or because of the house or because of the theme that it is addressing?
Right. So I looked at some hard data that in 2021 starting, there were almost 100 plus NFOs were flooded in the market, and almost 75,000 crore plus of assets have been added in these NFOs. I think most of these have been added because of, I think, again, these recategorization rules which SEBI has come up. After that, most of these fund houses had to fill their gap. Somebody doesn't have a flexi cap fund, somebody doesn't have a multi cap fund, so on and so on. And I think with the popularity of most of the index categories, I think fund houses are in rush to fill in these categories, wherein a Nifty, let's say 100 is not there, mid cap 150 is not there. They're trying to fill in all these gaps from that. But if I look at from an investor perspective, my biggest question is it a unique offering? I think unique offering is very critical for me. And I think 90 to 95% of these NFOs are something which is already available in the market. I don't find anything unique in most of these offerings which are coming in these NFOs. And I think from a performance point of view also, these NFOs have not done that great if I look at the hard data. What I would always strongly recommend is to look at attribution, right? What is that fundamental attributes of that scheme? What is the asset allocation which that NFO is looking at? What is the investment objective which this NFO is looking at? Does your existing fund which you are owning, is there anything different which this NFO is giving you? I think then only you should see a need. So let's say if you don't have a NASDAQ and let's say NFO of a NASDAQ fund is coming, and I think there were some challenges in terms of global funds also in the market. So maybe one can look at a NASDAQ fund NFO, right? That could be always explored. But most of the time it has been driven out of need for a fund house to raise AUMs, not looking at an investor angle. Again, one another challenge I have seen, most of these NFOs are launched when the market is in momentum. I have never seen these NFO launched at a when the markets are doing bad or in a bearish mode. So that is again a reason to garner and more AUM. I have seen most of the fund houses try to time their NFO timing at the time of when the markets are at the peak level. So may not be the great time for an investor to invest into it. So my suggestion is look at these 3-4 fundamental attributes. If you find something very unique and something missing in your portfolio, then only look at it. Otherwise, it's completely avoidable, and I never recommend an NFO.
So for the ones that are likely to come out over the course of the next couple of months, you're not finding these attributes, and therefore you are not recommending to your clients to look out for these, right?
Yes, because most of these are filling the gaps. That's what I'm seeing right now.
Okay, fair call. Santosh, your view could be entirely different, but what is your view?
I'm sorry to disappoint you. We're going to go towards some sort of consensus here. Is that I think with the way the SEBI is structured now, the application of new fund offers and even the launch of new fund offers, there is little leeway in terms of what our AMC can do, but fill in the gaps of the bouquet of services that they already have. Now, I still see that many don't have multi-cap, and I'm certain that in the next few days, when the embargo lifts and SEBI permissions are a little more easier to come by, a lot of multi-caps will come because everybody converted their erstwhile multi-cap into a flexi cap, and I think we've discussed this in the past. And so, therefore, from an investor perspective, I think, is there something new under the sun? Is a big question mark, because if it is new and if it adds value, then there is a reason for us to get excited about a new fund offer. Now, for a mutual fund company, it's good because for them it is new because they don't have it in their basket. From an investor, there is a peer group available. Now, how do we mix these two? The challenge is, like what Tarun said, that usually these NFOs come and the markets are very buoyant and a lot of momentum in the market. Now, we also have to understand that even investors like to invest only in a buoyant or a momentum driven market. You go to an investor and tell him when the markets are down and beaten, they're not going to even give you 1 rupee, even if it's a large cap fund or a small cap fund. Now, you can make 100-slide presentation about value, about the benefits of long-term investing and benefits of investing in a down market. Those all won't go down and won't be appreciated. But from a perspective of launching a fund, you always want the right mix of the product in itself being something that the AMC wants, and also the market momentum being in the right space. So I think the AMCs are doing best what they want to do, that is come out with the fund that they want. Now, when you look at this, today, the reason why some of us can look forward to some of the NFOs, though it is not a blanket sanction for all the customers, because there are very good peer options already with attribution, with enough of background of performance.
Sure.
Is that a classic example? You have a new a mutual fund entrant right now, White Oak, launching their flexi cap fund. I'm sure when their approvals are there, they'll be out with the fraternity and the investors to come out and talk about their fund. Likewise, I think I read about Edelweiss coming out of their focus fund with also a new portfolio manager in line for them. Now, when you look at these two things, what does it tell you? That a particular fund house feels that they can do well in a particular space which they do not already have an offering, or a new AMC is coming out of the new opportunity, and of course there will be believably a new story to believe that why they will do better in that category or that space. Now, if it augurs well with the investor at that particular point of time, if there's money going in, can they consider to give money to a new fund offer, considering the fund is going to be beginning on a new track record and does not have a past track record? Then you actually rely on the pedigree of the mutual fund company, pedigree of the fund manager, pedigree of the reason of this the previous fund offers, whether they are there to collect money or whether they're there because they can add value to the subject or the scheme objective that they're going after. So there is no easy answer for this, because I know many in the fraternity you can take an answer saying, no, we don't do NFOs, we only do old fund offers, and it serves them well. But there are many also who are willing to, for the investor who's looking at that as an opportunity, if the investor is fine and the story that the fund house is presenting matches with the investor profile, particularly, I think that's the bottom line. If it matches with the investor profile, though it's a new fund, because sometimes you have this luxury in the new fund where they take that 30, 90, 100 days to even deploy the funds. And markets like these, you want a lot more spread out investment time horizon than the money going in at 80-90% invested level straight away. So there are benefits and disadvantages of it, but I think one could take a individualistic view on these new fund offers that are going to begin right now.
So any particular that you're watching out for, Santosh?
See, I don't actually anticipate or watch out when these things come. We actually go through every one of them before we say a no. So right now, I have heard about the White Oak FlexiCap fund, which is going to be, I think, their maiden equity NFO, and I'm sure for them there'll be a lot of expectations to get that fund right and do a good job for it, because they come with a background of a great stellar fund management team and also a successful track record on the PMS side of the business. Now, there's also Edelweiss, which has also got its own set of funds trying to do a focused fund. Beyond this, I know there are many more. They're holding back to communicate more to us to figure out what their offerings are.
Okay, so I think play it as it comes. Watch out for some of these. Maybe viewers, what we'll do is when the fund offerings are announced, we'll try and talk about whether the NFO is good enough to subscribe or no on the mutual fund show or via some articles maybe. But for now, take it as it comes. Both our guests believe that NFOs may not necessarily be the best way to invest in. You can look at alternatives. In certain cases, select pockets, they might actually turn out to be good. So maybe take it case by case. But gentlemen, on that note, we'll call it a day on this leg of the mutual fund show. Thanks so much for being with us today, and have a great evening.
Yeah, you too. Thanks, Neeraj. Thanks, Tarun.
Thanks.
The pleasure was ours. Viewers, thanks for tuning in.